The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Oh, happy Wednesday, everybody. It's Squawk Box with Karen Cho, myself, Steve Sedgwick, and these are your headlines. Deflation concerns continuing to stalk the Chinese economy. Industrial profits sink in October, whilst officials push back against Donald Trump's tariff pledge. US markets shrug off the tariff threat yet again, instead cheering the Fed minutes and signs of further easing, with attention now turning to today's pivotal PCE print.
Sources tell CNBC that OpenAI employees are set to sell around $1.5 billion worth of shares in a tender offer to SoftBank. A US brokered ceasefire between Israel and Hezbollah begins, ending more than a year of conflict at the Lebanese border. But Israeli Prime Minister Benjamin Netanyahu warns he's ready to respond if the deal is broken.
Hezbollah will violate the ceasefire, not only if it fires at us, it will also violate the agreement if it tries to arm itself in order to fire at us in the future. We will respond strongly to any violation of this.
Good morning, Karen Cho. How are you?
Very well, thank you. You?
Yeah, very well, very well. I'm mildly disappointed, though, because we had...
About the fresh records?
No, not about the fresh records, no. I guess somewhere along my passive investments, I am invested, so I guess I don't mind necessarily, or unless it's going to lead to some crash at a later date.
Put your hand up out there if you don't have some S&P 500 or some Dow exposure.
I don't know. Honestly,
in
it's all in there. I don't look at my pension on a daily basis like you don't.
Any world indice.
I'd imagine there's something somewhere. My only worry, of course, is are we pushing it so far that we're in a July 2007 type era as well? And the only reason I mentioned July 2007, actually, I wasn't going to go here, is because actually a lot of the Conference Board survey of consumer confidence for November, it stands, wait for it, almost exactly where it was in July 2007, which of course is the first stage of the financial crisis. This is Carl Weinberg who's updating me on this one as well. So yeah, great. If my assets are going up, I'm really, really happy, unless we're in July 2007 2.0. That would worry me.
I was just looking at the chart on the S&P 500. It's almost a straight direction up in 2024. A couple of hairy months. If you got through the month of, April, April was a little bit of a down month. Then, of course, the August event that we all sort of stood back and said, what exactly are we dealing with here? And then September again. But if you just glossed over those three events over the course of the year, it was pretty much a straight line higher.
The market, as ever, is incompetent at taking out protection. And I mentioned it because everyone says, oh, look at the VIX. The VIX is a great indicator. Well, the more profit you get out there with your long positions, because most of you are long, very few of you are short the market, very few are leveraged short especially as well, you'd think maybe you either take a bit off the table or you create some form of downside protection. You don't appear to be taking out much downside protection. Year to date, it may be up 13.2%, but bear with me. I think the VIX month to date is down, and of course we've had an election, I get that. It's down over 30%. It's trading right at the bottom of its recent, lovely, what a lovely chart. Gosh, you lot are very good at this in the gallery. Well done. Is that Sophie? Well done, Sophie. Shout out to Sophie. She's a master of her art, a mistress of her art. I don't know. Anyway, 39% lower month to date. So, everyone said, oh, well, the insurance price. You're clearly not initiating long contracts on downside puts if it's down 39% month to date, despite the fact that, as Karen pointed out, it's a straight line to the upside on the S&P.
I was just looking back over the last couple of years, or actually the last 10 years, and if you see what happens in the year end, you can make the argument that...
Oh, Santa.
Is there any room for Santa to turn up into year end? But a lot of these markets can still grind higher into year end. So even as we talk about records today, is there still more in it?
Who would bet against it? Anyway, let's move on. We'll go to the other side of the Pacific because Sam Vadas is waiting. So, come on, you guys, hurry up. Chinese industrial profits sank by a tenth in October compared with the year before, narrowing declines on September, which showed a more than 27% slump. But for the first 10 months as a whole, earnings were down 4.3% versus 3.5% pullback in 2003. Not great, is it? Meanwhile, the Chinese state media, of course, has criticised President-elect Donald Trump's threat to impose an additional 10% tariff on all goods from the country, with the China Daily warning there are no winners in tariff wars. Well, you are a winner, viewer, because you've got Sam Vadas now. Sam, talk us through these multiple stories.
Don't worry, Stephen, Karen, you take your time. I always enjoy your conversation. You always learn something new, don't you? But yes, let me start with the industrial profits, because it does seem like a little bit of a case of bad news for the economy, good news for the markets, because no doubt continuing to build the case for more stimulus, which investors and traders are absolutely fixated on at the moment, laser focused on what Beijing is going to roll out next as far as some of the demand side stimulus. And what we got was just a slight improvement there as far as narrowing the declines that we'd seen the previous month, which was the worst slump that we'd seen in about a year. But while we have certainly seen an improvement on a sequential basis month on month, thanks to perhaps some of the investment in the higher technology sort of manufacturing, which we know that they're pumping a lot of capital into at the moment, we still continue to see the squeeze on margins. And this is problematic for the economy, given, of course, we do know that this means that companies aren't able to hire more people. That feeds into jobs and, of course, long-term income expectations. That feeds into the consumption picture as well. And so that is why this is sort of building, as I say, the case now for more stimulus. No doubt China keeping some powder dry. That certainly has been the view as we await Trump's trade policy to become a little bit clearer. In the meantime, let me walk you through what has been the reaction from China over the last 24 hours since we were last speaking sort of yesterday about this. We have had the foreign ministry coming out, and they have been defending this on the basis of their counter-narcotics policy, as well as their trade with Mexico, because remembering that Trump has long had a problem with, of course, China's perceived unfair trading practices. But this latest complaint, if you take a look at Truth Social and what he's actually said about this with the additional 10% tariff, is based on his concerns that they've not been doing enough, that is China, about stopping fentanyl from coming into the US. Now, remembering under international pressure, China actually did change a few things back in 2019 when this initially came up, and they did actually try to control some of the fentanyl-related substances that were moving around the place. But there seems to be still some concerns about some of these chemicals and China's role in all of this. And so what China has said is that it very much has been doing its part as far as this trade is concerned, and that shouldn't be taken for granted. Then on the Mexico part of this, on the idea that these products are, of course, going through Mexico and making their way into the United States, China sort of pushed back on that and very much highlighted the fact that a lot of these imports from China were helping the development of Mexico's manufacturing industry and helping the lives of everyday Mexicans as well. And so they were the lines from China as far as those two issues are concerned. Of course, we know that they've also said that no one wins in a trade war. But you could say the response so far has been fairly measured. They don't really know what they're working with at the moment. This really has been just, more talk than action. And very much the view is that this is basically a negotiating tool. This is where we start as part of the sort of art of the deal. And, we'll go from here. So I suppose that China is waiting to see what the contours of this trade policy is actually going to look like and how it's implemented, which will be key. And then just lastly, finishing up, more importantly, how they actually support the domestic policy and economy in order to withstand and act as a buffer against those trade tariffs, guys.
Sam, thank you very much for that. I think it is a maths equation that still needs more numbers for markets. You can see Trump plus tariffs equals selling on markets across Southeast Asia. We've been seeing it across in northern Asian markets. It's taking place. And the Nikkei is trading down. Some big auto stocks in particular have been on the back foot. That market down another 1% today. South Korea as well, similar story as we talk about high-tech industries and what sort of disruption could be coming from any further tariffs. so down just over 0.8% on the Kospi, but slightly more resilient today, as you can see, the Hong Kong and Chinese markets, which are moving into positive territory. Well, US markets, there was a lot of cover again. If you look at international markets being linked to Wall Street, and the gains we're seeing inked here day after day, again, fresh records on both the Dow and the S&P 500, about a whisker off 1% or less on the Nasdaq in terms of touching its all-time high. So there's been a fairly decent momentum, you'd have to say, for those US boards. A lot of tech stocks in play yesterday to the upside. Microsoft, one of the big drivers that we saw from the major boards in session, but there have been other players, and we saw it Amazon yesterday for the Nasdaq. So tech names that investors have been keen to snap over the course of 2024, now back into the mix for traders into year end. In terms of what we're seeing elsewhere, the dollar trade, this is how it's playing out. There's been some disruption on foreign exchange markets around the potential from fallout from tariffs, and you're seeing casualties on this side of the world. Euro dollar sliding 104.78, roughly morning session, now 0.1% in the red. Cable, we are steady to slightly weaker. Dollar yen, we're seeing a bit of a drift there as the safe haven Japanese yen gains some territory, and also the Swissy as we talk about the safe havens. To treasury markets, and the yield we're looking at as we digest minutes of the Fed that we'll get into in just a moment. You can see the short end of the curve, we are reversing. We're just shy of 4.25% and just off 4.3 on the 10-year, Steve.
Thanks, Karen. The latest Federal Reserve minutes point to increasing confidence that inflation is falling and the labour market remains robust, paving the way for further rate cuts, albeit at a more gradual pace. The FOMC voted unanimously in November to cut the benchmark rate to 4.5 to 4.7% range. The markets are pricing in a two-thirds chance now of another cut in December, although those odds have come down following President-elect Donald Trump's tariff announcement. Donald Trump has tapped the trade lawyer, Jameson Greer. The team were disagreeing with me. I thought he looked a little bit like a skinny Wayne Rooney, but no, the team doesn't agree with that. For our American audience, Wayne Rooney is a soccer player. Jameson Greer as his pick for US trade representative. Greer served as chief of staff to former trade chief Robert Lighthizer during Trump's first term and was part of the team that imposed the first round of sweeping tariffs on China and renegotiated the US trade agreement with Mexico and Canada. Elsewhere, Kevin Hassett, who doesn't look like any Premiership footballers, has been picked to lead the National Economic Council. He served as chair of the Council of Economic Advisers during Mr. Trump's first term. Sophie Baig joins us, economist at Morning Consult. Sophie, thank you for waiting. I know that you've been waiting as well for us to finish other matters as well. Sophie, all the excitement appears to be on the politics, very little excitement on the economics. There were about 10 to 15 major pieces of data yesterday, plus the minutes. I got to be honest, I'm not sure what I learned, but you're the expert. What did you learn?
Thanks for having me. I have to disagree. I think the economics is interesting, but in the FOMC minutes, what really stood out to me was a couple of things. The first thing was the division between the Fed officials. So it seems like there seems to be a little bit of a disagreement or maybe not a consensus on the future path of policy easing. Some appear to be a little bit more cautious on inflation not easing fast enough and perhaps calling for maybe a more gradual pace of rate cuts, while others think that if the labor market continues to cool that the way it is, that we might need to continue on the pace that we're at now and keep cutting rates.
Sophia.
So what stood out to me was there's the division, and then there's also just maybe teeing up Fed watchers in the markets for potentially a rate pause.
Sophia, and I think I called you Sophie, apologies for that earlier on. Sophia, I had a bit of a back and forth with the governor of the Bank of England quite recently, and I was saying, but the Trump situation, the Treasury situation, the CBO looking at their budget deficits going forward, surely that makes you more cautious on this side of the Atlantic. And he said, we can only play the cards that are being dealt now, not future hands. Is that similar with the Federal Reserve, i.e. they can only act on what they see here and now rather than what they fear or what they expect from Mr. Trump's administration?
So the Fed is really cautious about being independent from politics. So they try to not discuss politics or talk about it. It has been shown that they've thought about the idea of tariffs and how that might affect the economy. So they're definitely going to be doing some forward looking when it comes to how that might affect the economy going into 2025. And honestly, they should, because that could really change the path of the policy rate going forward. But they tend to try to stay out of those things, or at least present a unified front that they're not going to get involved in politics.
Sophia, the minutes suggest that the Fed could just hold if they think that they might not quite be bringing inflation back to target. But to me, the problem seems to be that they are stumbling around the dark looking for the neutral rate. But that is a moving target. It's not where they think it is. And if we get changes in policy next year under a Trump administration, that neutral rate could actually be going higher, couldn't it?
That was another thing that stood out to me, that they seem pretty unsure about where the neutral rate is, and pretty honest about that there's disagreement or unsure thoughts on where exactly that neutral rate is. It seems like some people think it's a little bit higher and some people think it's a little bit lower when it comes to the FOMC participants. But yeah, that neutral rate could definitely change going forward, especially if all of the policies that the Trump administration is proposing do go into effect at the scale and the speed that they're proposing. That could really change the price level and could affect the Fed policy going forward.
What are the longer term implications of this? Because we've been looking at a very resilient US economy for a while now. Does this suggest that boom bust is more likely to be a consequence if Trump doesn't get it right?
So with morning consult data, we show that, we heard a lot about excess savings during the pandemic. A lot of Americans had a big buffer of savings, which I think helps them chug the economy along during this past inflationary surge. But I think that now household finances, in our data, they've shown diminished savings and a lot of weakening, especially for those lower and middle income households. So I don't think they're quite as prepared to weather any more inflation or, sustained job losses. So the economy continues to remain strong and robust, but there are certainly headwinds, and I don't think households are as prepared to deal with them going into the new year if something does take a turn.
Sophia, that is the point, isn't it? It is the labour market that matters here. And we were talking to Manpower this week, the CEO telling us that the labour market is still cooling in slow motion. So the narrative that we started 2024 with is how we finish up. If that is the case, if most Americans are really holding on to their jobs and still getting incomes, and let's face it, a lot of negotiated upside in those wage contracts in recent months and years, then even if things are tougher, it's not calamity because they've still got a fairly decent income, even if things are tougher.
Mm-hmm. And what sticks out to me in the labor market is the cooling that we've seen is not really coming so much from layoffs or unemployment. The unemployment rate is actually quite low at 4.1%. But what we're seeing is more of a slowdown in hiring, a slowdown in wage growth. So there is some cooling, but like you said, most people do have a job if they want one. And if you do have a job, you have that income and you can keep paying your bills and keep the economy afloat. So right now, although the labor market is cooling, we're not seeing sustained job losses or anything to be concerned about at this moment, but there are headwinds going into 2025, as we discussed.
Sophia, there aren't many Brits who celebrate Thanksgiving, but there are a majority of Brits who celebrate Black Friday. I don't know why we take some of your exports, but we don't take others. But that's the point. In terms of Black Friday, are those Americans who you just mentioned, who are by and large keeping their jobs if they want one, are they going to be spending their money this time round?
We in morning consult data, we expect a good, strong Black Friday. What we've seen a lot is that high income consumers in particular have been spending a lot in 2024, and they've been propping up the US economy. But I think consumers at all income levels will be participating in Black Friday. Something that we see year after year is it's not just for holiday shopping. It's also just a time where people can take advantage of sales maybe they've been waiting for all year. So I expect to see a strong Black Friday. People are doing pretty well right now, and this is a Brits and Americans alike will be participating happily in Black Friday.
Terrible. We're worse than Americans at spending every single penny in our paycheck, I can assure you. Most important question, Sophia, are you waiting? Have you held off, or have you just gone full pelt buying on the early deals?
I'm waiting. I have been peeking, but I've noticed that the deals are not so good right now. If I'm going to participate in Black Friday, I want it to be 50%, not 15%. So I have held off and I'm waiting for those really eye-popping deals.
I couldn't agree more. There is a certain US sneaker company that may or may not be based in the Northwest, a little bit higher than San Francisco, that are not reducing their running shoes that I want. And it's a great shame. I won't name the company. If our viewers can't work it out, then they're a bit dumb. Thank you very much indeed for that, Sophia. Lovely to see you. Thanks for all your comment. Much appreciated. Sophia Bake, who is economist at Morning Consult.
Extra 10% off. That's all I can say.
There is a certain brand of a certain shoe which is never discounted.
Really? Not even a Black Friday promotion, extra, 10% off on checkout?
Tiny sometimes if it's the wrong colour in the wrong size. But no, it's amazing.
Well, you're colourblind, so this is great.
I see colour. I just don't know which they are. Anyway, I love your green top. Is it green?
Yeah, it is.
It's genuinely green.
It's emerald green.
No, it's not. What colour is it? No, seriously, I have no idea.
It's a strange sort of a rusty, nondescriptic colour.
Rusty green, yeah?
Yeah.
I have no idea. Genuinely, it's the joy.
Rusty rose colour.
I used to be a trader, as you know, and I once came back with this like orange and blue striped shirt with like an orange stripe in it and this green tie, and my partner at times, what the hell have you? I don't know. It looked nice.
It's National Clown Day.
National Clown.
We've got to push on, don't we? We've got to talk about interest rates.
Yeah, that's okay.
I think that's what the clown does too, doesn't it?
The tears of a clown. Yeah. Oh, very good. New Zealand Central Bank has cut its benchmark rate by 50 basis points to 4.25% as expected. National Clown Day, and flagged further easing ahead. RBNZ Governor Adrian Orr said that even with a half-point cut, policy remains restrictive and that there is significant capacity to continue loosening in the new year. Karen,
coming up on the show, Huawei launches its newest smartphone as it bids to break away from depending on US technology. We'll have the latest. Plus, a ceasefire begins at the Israel-Lebanon border, ending more than a year of conflict. We are live from the region. And a group of UK parliamentarians slams the country's financial regulator as incompetent at best. We'll speak to the group's chair, Bob Blackman, at 8:30 London time.
Welcome back, everyone. Shares in Dell fell 10% in after-hours trade after fourth quarter guidance missed Wall Street expectations. This despite the PC maker beating analyst estimates in the third quarter. Now, net income rose 12% on the year, whilst overall revenue slightly disappointed, coming in 10% higher. HP shares also dipped in extended trade after forecasting first quarter profit below Wall Street expectations amid sluggish PC demand. The computer maker now expects adjusted EPS to come in between 70 and 76 cents in the first quarter, below analyst estimates of 85 cents. OpenAI is allowing employees to sell around $1.5 billion worth of shares in a new tender offer to SoftBank, CNBC has learned. One person familiar with the matter said SoftBank CEO Masayoshi Son had been persistent in asking for a larger stake in the AI firm after putting $500 million into its last funding round, whilst another source said the tender is unrelated to plans to restructure OpenAI into a for-profit business.
Huawei has launched its new smartphone series, Mate 70, in a move away from US technology in the wake of sanctions. The device is set to launch on the 4th of December, run on Harmony OS Next, the company's first fully self-developed mobile operating system. Adrian, first I was just looking at the device. It looks like a submarine porthole. This big round lens, quite different to what the iPhones have. But big device, big launch, but also the operating system and just how far the Chinese have accelerated to catch up with the West is key.
Yeah, that big camera actually was one of the big innovations Huawei had early on in its journey into one of the leading smartphone players in the world. But really, this is all about not so much the hardware, but really around that software, as you mentioned, Harmony OS Next. So in 2019, a bit of backstory, because of US sanctions, Huawei were effectively cut off from the Google Android ecosystem. And so they pushed forward with developing Harmony OS. At the time, they were effectively using open source version of Android to build this. But more recently, they've divorced themselves completely from any Android and built this from the ground up, and are now rolling out across these new Mate 70 series of phones, as well as the Mate XS foldable that was launched as well, and for their upcoming devices as well. And it underscores really what's happening in China right now is this continued drive for self-sufficiency.
Can I just reverse back a little bit? So do they use open source technology to get them to a place where they could then separate and use that base level to create their own technology?
That was effectively what was happening. They were building it up and then at the same time developing on the side their own operating system, fully self-developed.
Does that mean there are implications around AI? Because I know when it comes to, say, the likes of Meta spending truckloads of money developing AI, and they want it to be open source, does that mean a similar thing could happen where if the Chinese see advances to be made thanks to US technology, they use the open source to get to a level again, and then they go in a different direction?
Well, the AI conversation is fascinating, actually, and just coming off the back of the last 2 weeks traveling around tech conferences, one of the things I've learned is that Chinese AI models are performing stunningly well against the likes of OpenAI and others. And these models are open source, developed out of China, based on Chinese technology and Chinese companies, the likes of Alibaba. There was a big one the other day called DeepSeek, which was launched, which has got very good reviews as well. And these are actually globally some of the most downloaded AI models that are being used for developers, not just in China, but outside too. And so if we think about how China is progressing with their AI models, it's not so much these closed systems, it's actually open source, because the likelihood is if China comes up with a very powerful closed system, there will likely be some sort of US sanctions around that, and it'll be very difficult for China to internationalize that. Going open source means that they can distribute these on various platforms that can then be downloaded by developers. And on the AI front, Huawei spoke a lot about that in terms of their own operating system and some of the AI features on the devices, and very key because it's coming ahead of course, the highly anticipated launch of Apple Intelligence in China.
Apart from that foldable screen, is it me, or does everything about that look exactly the same as you get from the dare I say it, from the Apple? I mean, there's so much of it looks very, very familiar. Are they all just I mean, I'm not saying they are plagiarizing, I'm not saying they are stealing IP, but it all looks so similar to what we... I mean, everything about these phones and those graphics looks very familiar.
Huawei's phones actually... They came up with a lot of new stuff before they were hit hard by a lot of the chip restrictions in particular. They innovated a lot around the camera, around the screen. So actually, while it may look sort of a bit samey now, they were...
Under the hood, it's very different.
Under the hood, it's very... But also they pioneered some of the design choices, a few years back.
So very, very briefly, because we've got a guest waiting in the wings as well. You said hard to internationalize. Do you mean hard to internationalize in America, or actually hard to internationalize globally?
I think... two things. On the device front, hard to internationalize globally now for Huawei because they do not have access to Google Android, and that's what users outside of China want. When it comes to these AI models, I think hard to internationalize definitely in America, but of course Europe still remains a little bit in the middle in terms of its relationship to Chinese technology at this point.
Arjun, great analysis. Thank you very much for bringing that to us. We're going to push on. Coming up, plenty more, and you can also get those details on Arjun's story on CNBC.com. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.